Morning, this is Bill Riley with Riley Private Client. What we're going to do today in this session is explore some of the happenings, or I guess the events, that have happened over the last few days in the markets and also some economic type situations. You know, last Friday I was sitting there having coffee before I came into the office and was watching CNBC. And a lot of they always have this panel that tries to decide what the job report numbers are going to be. So I was listening to it early or late Thursday night, and some of the guys on Bloomberg were giving out numbers that were very surprising to me. Maybe 1.2 million new jobs and 1 million new jobs and all that kind of thing. Well, I've been doing this long enough that I kind of take that with a grain of salt, because I started thinking, how's that really going to happen? I mean, 1.2 million new jobs? Well, sitting there and watching the TV, drinking my coffee, and all of a sudden here they come. 245,000 new jobs, not 1.2 million new jobs. And I wish I would have recorded the faces of the guys that were on the panel. And these are very premier type economists. It was like they were in shock. I mean, it was like, oh my, what are you talking about? In fact, one of them actually said, does somebody need to check that number? That can't be right. So let me kind of look under the hood there and kind of explain to you why predictions in my profession can make you look very foolish. You should be observing, not predicting. Basically what happened is that the guys that came up with these figures, or these predictions, really were banking on the fact that we had all these people that are going to go back to work. Well, it didn't quite work out that way. Forgive the double entendre, but it's very hard when I have clients that run restaurants and run small businesses and even the guys that manage Walmart. When you can make more money staying at home than you can to go have a job like being in the restaurant business or the service business, why would you want to come back to work? And I think that's something that Yellen and Biden have kind of missed here, and they tried to make excuses for it. But Bloomberg over the weekend came out with a report saying that the average family that were in, what you call lower income models, that if they both were out without a job, that between the stimulus checks, the unemployment, and then the unemployment bonus on top of the unemployment, took home almost $41,000 a year. Now, if your world is in the service industry, and I'm not taking anything against that, but if your job is to go be in that industry and you can make almost as much money, if not more, by staying at home, why would you want to go to work? Now, this is where stimulus and this is where government kind of misses the boat. There's a lot of people that are getting these stimulus checks that really don't need the stimulus checks. I mean, I don't know if I talked about it last time, where the two guys were going into a casino in Vegas, and one of the news guys on the street said, oh, it's great, they're filling back up. Here's two individuals here, and they both held up their stimulus checks as they went into the casino. And I'm thinking, wait a minute, I don't think that's why we did this. So let's go on and talk a little bit about what's really going to happen here. I think eventually, people will go back to work and they want to work, but there's still 8 million people that don't have a job, that had a job prior to the pandemic. One of the greatest economies I've seen in my history of managing money. But if you don't have an incentive to do it, then why should you do it? And they'll just wait. And all these run out in September, so that could be a change. And I think going forward, the next report on jobs next month will show a tremendous increase, because eventually people will need to go back to work. But here's the repercussions of that. This will allow the Fed to continue on allowing inflation to creep up. It won't be fast, but I'll tell you, if you've ever read, or I'm sure you haven't, but there's a formula that the government uses to determine what inflation is, or the amount of inflation. The first thing they do is they strip out all food and energy. That's right, they strip out food and energy. Well, a majority of us spend a lot of money on food and energy, and that's where inflation is coming from. All of us have heard the story about the lumber being 300% higher than it's ever been. So when they measure inflation, that's why sometimes inflation gets away from them. They don't really put in what we as individuals spend our money on. For example, when I filled my car up over the weekend, I looked down and it was $10 more than it had ever been. Now that's not a lot, but still it was $10 more. So there you go. And that's what, when you allow things like this to happen and you want inflation to come back, it overshoots. And that's what I'm a little bit concerned about, is that to stop inflation, then you have to raise rates. And the Fed keeps saying they're not going to raise rates. Well, if inflation runs away, you have to. That's the only way to control it. So let's talk a little bit about where interest rates are going. I think that interest rates, even though we're hovering around the 1.6 on the Treasury, will eventually go back to 2%. And over about a 24-month period, we could see 3%. It's just a natural part of it. You've got to remember that, the normal yield on the 10-year Treasury is about 4%. So, we're way below that. And the Fed will allow that to happen on almost a normal basis because it's not bad, but it can get a little unnerving, especially on things that are interest sensitive in our economy or our investments. Now, let's go back to this thing about predictions versus observations. Predictions are based on what someone has an opinion on. And that's what you see on the news services. They have an opinion. It's like, we should buy this stock or sell this stock. Basically, it's based on their opinion without a lot of fact, believe it or not, not a lot of fact. Eugene Fama, the great Nobel Peace Prize winner, which I'm a student of, has said that no one can predict the market, and you can't. Everybody's tried. I've even spent money in my past career on people that came up with software that said we could predict the market. It didn't work. It worked for about maybe 2 years, and then it fell apart because the market is fairly inefficient. Everybody thinks it's efficient, but it's inefficient. There's a good example was the jobs report. For all intents and purposes, if you were looking at it and studying it and going through the numbers, we should have 1.2 million new jobs. Well, it didn't happen. So then when you go back and look at it, you figured out, well, we didn't factor in that people didn't want to go back to work. So that was one part of it that just didn't work. I like to observe. Dr. Fama, said that if you're basing your investment portfolio on predictions, you have a failed portfolio. Now, what do? Well, you use common sense and observations. Take, for example, some of the tech stocks. Everybody says, well, they're selling off this morning. Well, the FANGs, which we call them, the 5 big boys, do you think that they're going away? Do you really think that stocks like Microsoft or Apple or some of these others are just going to, oh my gosh, they're going away? No, they're not. Just because everybody's going back to their offices in July and August, you're still going to use the software and you're still going to use your computer. So this is where predictions and these guys that come out and put a sell signal on something, they're actually traders. They trade stocks. I think a good investment portfolio should be an investment. And you should use opportunities to add to positions when this goes through instead of selling positions. So I'll close there and just kind of keep this in mind. Predictions can be detrimental. Just use good common sense and observations when you're putting together your portfolio, you're working on a portfolio. I'm a big fan of Warren Buffett. Buffett kind of comes out there saying, they'll ask him what he thinks about a new stock they put on or they're taking a position in this. He'll tell you right up front, ask me in 2 years and let's see how it's done. Too many people are trading, they buy it on Monday and sell it on Friday, and that just doesn't work. You get lucky, but about 90% of the time, you'll come out on the wrong side of that trade. So thank you very much for listening. I hope you're enjoying this. The next thing we're going to get into is more behavioral. One of the things I've been working on, I'm very concerned about, is as people get more and more into retirement, what are we going to do about income? And I've got some ideas for that I've been working on. They're a little out of the box, but I think it may be something that we may have to go to because if stocks start flattening out here and we don't have these big years, you can't rely on the growth of your portfolio to feed your income. We're going to have to find things that create income. So thank you very much. I hope you enjoyed this, and please call me 817-870-4680 or send me an email. I'd love to answer your questions and work with you on stuff. So thank you again, and we'll see you on the turn. Thank you.